Hello, and good afternoon. Welcome to the Wealthologist Live, our monthly time where we have some good financial conversations, right, Jacob?
I think we do.
Hopefully.
Yeah.
Now, as always, we always like to have a little bit of a story. So I asked Jacob, I said, Jacob, I've got a story while we're letting people come in. Should I share it? And Jacob said, yeah. And I thought about it. I thought, boy, are people going to take this like a little strange? And then I said, if people really know me, they know that I like to do some fun stuff. So I'm going to share a fun thing that I'm doing with my kids right now, and then we'll get into the topic. Several weeks back, I found a little plastic baby laying at the office here, and I think somebody had a baby shower or something at some of our tenants upstairs. Anyhow, got this idea. This the little baby. You can kind of see him right there. I was like, man, I should buy these and just put them wherever I go.
Right.
So we started doing that in Charlotte. You know, we started like putting them all over Charlotte and just having a good time with it. But we just went on a trip. We went overseas and we bought a bag of 300 of these babies. So all scattered everywhere. We've been, you leave them on landmarks and things like that, and just something to maybe make people laugh. But I got to tell you, I do it with my girls, and Renee hates it. My wife hates it, but my daughters, they love it. Yeah. Like, it is the best thing in the world for them because they're both like, Dad, give me a baby. We got to put one here because they want to put it in a spot where people will notice it, but it's, it won't get taken down and it'll make people laugh.
Right.
So the funny thing is, my dad's going to be traveling where we just traveled to. So he said,
You may find some.
yeah, what if I'm walking out and about and I see a baby somewhere? I thought that would be kind of cool. Anyhow, that's Chris's funny wacky story.
There you go.
If you are around Charlotte, there is a chance that you will find them. Some good places that we have hid them is at parking garages. You know where the gates go up and down. We'll put one right where you pay, so you have to see a little plastic baby for that. In restaurants, they're fun to put in plants. So anyhow, all right. Well, let's get on to business, shall we? It's good to have everybody back. And if this is your first time joining, we welcome you. If you are a client or you've been with us before, it's good to have you back. As many of you know, I'm Chris Hobart. I'm the Wealthologist. And with me is Jacob Woodrum. He's our lead investment strategist here at Hobart Wealth. And we're halfway through the year right now. We're kind of a lot of stuff going on.
Yeah.
A lot. Quite frankly, just in the past 2 weeks, 3 weeks, major changes in the political environment and things like that, which can have some impact. And I think we're going to talk about that near the end.
Yep.
But we're halfway through the year. It's been a pretty good year for markets, but. What I wanted to do, and it's what we did with Andrew last time, is we're gonna continue with the concept of the 3-2-1, and the 3-2-1 is going to be having Jacob in a timed manner to make sure we don't go on too long.
Put me on the clock.
Exactly.
Put me on the clock.
You're going to talk about 3 economic factors that are important right now. We can have a little bit more time, and I can ask you some questions. But three important things going on right now. 2 of your favorite portfolios that we're managing right now, and then 1 thing that our clients need to know about or that's important or we're hearing from our clients right now. And that's a 3-2-1.
Yep.
You ready?
I'm ready.
All right. Well, then, if that's the case, let's 3-2-1 this thing. So to start, we're going to go with your 3 top things going on in the economy. So if you want to go ahead and just hit us with number 1, I'm going to get my handy dandy little timer out here.
He's putting me on the clock, people.
You are on the clock. All right, go.
All right. So the first thing that I want to talk about really is growth. So economic growth. That's been from an economic perspective, really one thing that we've been watching, and it's been really interesting to see. We've had really 7 consecutive quarters of GDP growth. Now, when we talk about GDP, Chris is always quick to call me out. So I'm going to explain GDP. It's gross domestic product. It's the amount of goods and services we're producing on a given period of time in the economy. And so it's really important to pay attention to. We recently had, actually yesterday, we had a report that came out, GDP report, where growth grew 2.8%. Over the annualized over the last quarter, and the expectation was for 2.1. So it was a good report in that we saw increased growth. But we are going to talk a little bit about jobs and unemployment, because it's important to look at growth through the lens of jobs and unemployment. So I've got a slide. I am going to show that here in just a second. There we go. So this is a really important slide. It's just measuring unemployment rate over the last, 75 years, really from like 1948 through the current period of time. And what we're seeing in these shaded regions, the shaded vertical regions, are recessions, so U.S. recessions. And what we're really paying attention to, what we need to pay attention to here, are these dot plots. So when you look at these dot plots, what it's measuring is from cycle lows of unemployment rate. We're seeing, when we see an increase of about plus 0.6%, that is something to pay attention to. And my timer's going off, so I've got to wrap this up.
10 seconds.
But really, what we want to pay attention to with this chart is just to say, given where we're at, this chart would make it seem, we may be on the cusp of a recession. We're not saying that. We're not calling, a recession tomorrow, but we're seeing growth slowing, and it's something that we just need to be paying attention to and watching out for. So that's number 1.
Nope, that's great. And that's actually something I talked about in Wealthologist Weekly this week, our weekly video newsletter that we send out. So I don't have a lot more questions. I think the important thing that you pointed out is we do see growth slowing,
right?
And we see signs of that. One thing that I talked about in my video earlier this week is that the unemployment claims have gone up. This past quarter they're at this past month it was 235 claims, where at the start of the year was 211,000. So again, we're starting to see that climb, which talks a little bit about slowing, talks a little bit about consumer spending and all of that. We're starting to see some of that slowing. Doesn't mean we're going into recession, but it does mean that we're starting to see just some of those warning things, which also can change how we're looking at portfolios and what's going on in portfolios.
Yeah,
right?
It's important to pay attention to. And I think that graph shows what you were talking about with the report or the numbers, in that we're starting to see the unemployment rate ticking up a little bit.
Yeah, and look, we've had great unemployment rate for quite a while. So to have it tick up a little bit is not it's not awful, because it's still good numbers, right? But more people out of jobs, less people spending money.
Yeah.
The consumer spending makes up what,
2/3 of each GDP.
Yeah. So I mean, we're talking about something important. So if we see too high of unemployment, then we're really in trouble. Again, that was pretty low.
Right.
So we'll take low. All right. Economic factor number 2, what is it?
All right. So we're going to talk a little bit about inflation. It's been something we've talked a lot about over the last year and a half. But the one thing that I think is important to mention, at least for the time today, is that, inflation's a lagging indicator. So what I mean by that is, it's kind of today's inflation report. It just represents yesterday's policy, if you will. And so when we look at inflation, and I think we've got a visual for this as well. Yep, here we go. So when we look at inflation, it's interesting because we've been talking a lot about the expectation that we get inflation reducing and moderating or falling as we move into late summer, early fall. And that's really what we're starting to see. So this chart is showing us 3 different measures of inflation: CPI, Producer Price Index, and the PCE index. And we can see from the highs of 2022, inflation has been coming down and moderating. And just today, actually just this morning, we saw the PCE index, which is the Personal Consumption Expenditures Index, that was released, and it came in at a 2.6% annualized rate, which, if we look at where we were from an inflation perspective in Q1, we were sitting at like almost 3.7. So we've definitely seen inflation moderating, reducing. I think we're going to continue to see that. Specifically, I think home price inflation should begin to come down just because of the change in the year-over-year rates. And I do think that we're probably going to see housing continuing to moderate a little bit, but definitely not in an environment where we see house prices crashing or anything like that.
That's always good. Yeah. That's one of those tough things. It's you look on Zillow, you like to see your house price go up, but you got to think about it. You're a kid getting out of college. I mean, it's near impossible to afford a house these days. I mean, it's a tough world. Even the desire to move homes has changed quite a bit. I don't want to sell my house at this great mortgage rate and have to go buy something else at a higher mortgage rate. So those little things are kind of those underlying issues going on right now that happen because of interest rates and inflation and all of this together.
Right.
The interesting thing, though, is a lot of the typical a lot of times we would see some bigger ramifications around some of this, and it's really odd that we haven't seen that.
Yeah,
I do think that it's just the amount of money that was flooded into the system through that COVID area. 40% increase in our monetary supply.
Yeah.
I mean, liquidity like that solves a lot of problems. It also creates a lot of problems, and I think that's the thing that we're keeping our eyes on right now.
Yeah, it is. It definitely is.
All right. Number 3.
All right, last one, number 3. So we're going to talk a little bit about interest rates, and obviously that goes hand in hand with inflation. It goes hand in hand with jobs and growth. And there's definitely room, I think, for the Fed to cut rates, at the end of the year or towards the end of the year. I actually think that we're probably going to see a September rate cut. And the data is, it's definitely beginning to turn. I mean, as we talked about, we're seeing inflation coming down. We've seen the unemployment rate, ticking up based on those last 2 slides. And so we're definitely going to see rates, going lower into the future. And I've got a slide that we want to look at that I think is pretty impactful here that shows a couple things that we want to look at. But the blue line here is showing us the probability that the market is pricing in for a September rate cut. And we can see that it's at almost 100% probability, and 96%, and so there's a lot of confidence, at least at this point in time, that we're going to see a September rate cut. But I think what's even more interesting, and we'll talk a little bit about this because this kind of is a segue into the 2 strategies that I'm going to talk about, is that the black line is measuring the Russell 2000. That's an index. It's just an index of 2,000 different small cap companies. But what's interesting is to see the correlation or the way that those two lines are tracking, especially from like July 3rd, all on to July 18th, meaning that, okay, the market's pricing in a Fed rate cut, and the small cap stock market saw an almost a little bit greater than 9% increase, which just tells us that we should expect the market to continue to broaden out. And I know we've talked a lot about this over the last few months, but the big cap tech companies, Google, Apple, Microsoft, they've really been driving returns, NVIDIA in the market. But I think interest rate cuts should have a positive impact on some of these smaller companies that really haven't done well this year, from a growth perspective.
And just for clarity, when Jacob says broaden, right now growth in the market, as you pointed out, there's really a collection of 5 to 7 companies that's really driving all the growth. And then you've got the rest of the stock market that it's doing. Some are doing okay, some not. What's interesting about all of this is when we're talking about broadening is that more companies should begin to have better performance going forward, and it shouldn't just be solely dependent on this small group of
5 or 7 companies.
Exactly. Now again, is that the case? We'll see. It's interesting because you and I feel like every once in a while will disagree on interest rates and where they're going. And there's always a conversation that the Fed, specifically around elections, really backs off of interest rate hikes or changes rather. And I'm kind of in that zone of sitting there saying, I don't know. I think that if they're talking September, the election is a month and a half into that. That's really close to be messing with interest rates. And I know the Fed oftentimes likes to say, hey, we're not going to be. We don't want to have anybody saying that we messed with rates.
Well, it's interesting. I was even last night, I was in Uptown for a private markets event, just talking about different investment strategies and whatnot. And there were there was a panel talking about where they thought interest rates were going, this year. And everyone was divided. One person was saying September, one person was saying, we might not get any rate cuts this year. And so it just goes to show not everybody, no one ultimately knows, and not everybody's agreeing on.
All right, $5 bet, no rate cut until after the election. Rate cut in September. All right, so you can hold us accountable.
There you
go. $5, okay.
$5, yeah, that'll work.
That'll be. I can buy more babies. Plastic babies. That sounded wrong, didn't it? Anyhow, all right. So we talked about inflation. We talked about unemployment. We talked about interest rates, which were your 3 big topics. The other part of 321 is talking about 2 portfolios, specifically with all the things that we just talked about. What are 2 portfolios that we manage, that we work with here internally, that are compelling conversations for clients to have? Again, same rules. You're on a timer.
All right.
But tell the people what they need to know. What should we be doing in this economy? What portfolios are going to be working best?
Yeah, there's 2 that I wanted to highlight, and specifically the first one is really what I consider to be a tax efficient strategy. It's a dynamic tax efficient model that uses mostly individual stocks where we're looking to track a benchmark. We're saying let's track the S&P 500, for example, and but also let's ensure that we're tax efficient and we're trying to actively harvest losses within the portfolio. So to kind of, I guess, pull further on that thread, what we're really saying is, we want to invest in a bunch of individual stocks, and we know though, like the S&P 500, for example, like we were just talking, the market has been driven by a handful of them, 5 to 7, and so what we've seen so far this year is those 5 to 7 have done really, really well from a return standpoint, have grown very well, but the other 493, or 495. Some are up, some are down. Like they have not all done well from a growth perspective. So we have the ability in a tax efficient investment strategy to say, let's harvest losses, actively sell Coca-Cola stock at a loss. Let's turn around and buy Pepsi because it's going to operate similarly. And, we'll still have this environment where, last year in a model like this, the markets were up, or S&P was up 25, 26%. Well, our S&P model was up the same, 25%, but yet because we were able to actively harvest losses, we still showed a gain of 25%, but we were able to also harvest, about 7 to 9% of losses as well inside of that.
And I'm happy you brought this one up, because this is again a portfolio that I really love, simply because it is about getting market returns, and again, it's based upon the S&P 500, so it's seeking to get the full returns of the market. But the ability to create tax efficiency inside of that, again, we can't preach this enough. Again, I was just overseas. The tax rates in Italy, 63%.
Yikes!
63%. We're not even near there yet. Pretty much all of our clients are always complaining, I pay too much in taxes. I don't want it. I got to tell you, we're so far in debt as a country. I mean, over $34 trillion in debt. Taxes will be a way that this is solved. And if you've got money saved up in retirement accounts, or if you've got money gains inside of things, the more that we can do, the more that we can leverage technology to not just say, let's get good returns, but let's also find ways within that to knock the tax burden down. I mean, that's the American dream right there, right?
It's the name of the game.
All right, so that's portfolio number one.
Yep.
Let's go ahead to portfolio number two. Let me get my timer going. You're on.
All right, so second portfolio kind of goes hand in hand with what I was talking about on the previous slide that we looked at that showed the Russell 2000, which is a small cap index. I think there is some real opportunity for the small cap environment in general. And so the other model that I like, and I think that really could be beneficial for us moving into an environment where we've got declining interest rates, is really what we call our small cap, our dynamic small cap investment model, which is going to hold anywhere from 60 to 65 individual U.S. small cap stocks. And when we say small cap, think of a large cap or a mega cap, company would be like an Apple or a Microsoft, something that's really, really big. These are smaller companies. So there's more inefficiency. They're not followed as widely, and there's more opportunity to potentially outperform with companies like this. But we're seeking to track a benchmark. We're tracking the Russell 2000, and really the goal is to do it with less volatility, but the consistency is really the name of the game. And it's historically outperformed the Russell 2000. So it's something that, again, I think if we're moving into an environment where rates are coming down and we're able to avoid a recession, I think that this is a model that really could be benefactors of that type of environment.
Perfect timing.
Hey.
Well, and the thing is, you know that I'm a lover of the small cap. And I think the important thing to point out too is, again, those large and mega cap companies, typically all of those companies you have heard of or you use their products. Small cap companies you may have never heard of. They're still viable, but it just means that they're a much smaller company. To your point, they have different opportunities. It's they can move faster at times to take advantage of things in the market. But you talked about this being less volatile or trying to minimize the volatility compared to the Russell. It's important to note that with small cap stocks, volatility. Yeah, I mean that can be the name of the game. So this can be very attractive. It can be very fun, but also when we do go through some different economic cycles, small cap companies can react a bit rougher when it comes to some of the downturns.
They're more prone to, because to Chris's point, they don't have they don't bolster the balance sheets. They don't have cash on hand potentially like some of these bigger companies do. I think they're more susceptible to some of the environment, or the factors that could be occurring. And that's why the rates have, I think, if rates were to fall, the cost of capital is a lot less, which is beneficial for, those types of companies that are in that small cap space.
Nope. That's exactly it. Nope. So again, both portfolios that you brought up are phenomenal examples of what we can do. Real quick, are these appropriate for all of our clients?
Great question. No, I would say no, they're not. I mean, it depends. It's easy for us to talk about a portfolio and a strategy, and I think get real excited about it, but it is very important, and I'm glad you mentioned this, Chris, just to remember that depending on the goal, depending on what someone may be wanting to accomplish, it may or may not be something that we utilize because of the way the strategy operates or what it's meant to try to accomplish.
Okay, perfect. All right. So we're going to do something a little bit different. So we're doing the 3, 2, 1. And the one is one thing that you think clients need to talk about, or one thing you've been hearing a lot about clients. We also typically do what's called Hey Hobart. And Hey Hobart is where we have clients send in questions. Yeah. And oddly enough, as we were preparing for this this month, we're right on the same path. And surprise, everybody, guess what everybody's wanting to talk about right now? The election. I know you're surprised. Oh, first and foremost, I mean, what a crazy, just past 2 weeks. Yeah. I mean, we're not talking, and we're not going to go into all the political ramifications, but man, it is almost to the point where you just want things to be kind of normal. Yeah. And it just doesn't seem like there's a lot of normal with this. Right. So, but the question that I was preparing for Hey Hobart was around the election. Yeah. You know, what are the impacts of the election? I know you were preparing for the thing that you're hearing and you wanted to talk about was election. So let's talk a little bit about that. Yeah. Let's kind of share with everybody watching, what are the impacts of the presidential election? What might we be looking forward to? What might we want to be careful of going forward as well?
Yeah. Yeah, and it's one that it keeps coming up, and that's why we're talking about it today. But it is one that I feel like we've talked about before on some of these, wealthologists, and I will continue to try to drive home the point of looking. We can look forward, and that's one thing we can do, but also it's really important to look at the numbers, the statistics, and historically how things have operated from a pure performance standpoint, because I think that's really important. And when we look at the numbers, we look going back, and we've got a couple slides which I think will show up here in just a second. When we look at a few things, this is a good one, but when we look high level at this 4-year cycle, it's interesting because the year of a presidential election always and has been, over the last 100 years, the second best from a return perspective in this 4-year cycle. And this is research that was put out by Ned Davis, and it's just showing us 4-year presidential cycles. And so what's really important is not to say, as it says on the slide, we don't want to look so much at the level, but trend is what we're looking at here. And so what we've been saying for quite some time is that we expect late summer, as we move into the fall and get closer to November, probably to experience some volatility, some choppiness, some back and forth. And quite frankly, that's kind of playing out in the markets over the last couple of weeks. Yeah. We've seen that. But historically, we tend to see at the end of the year a late year rally in these years of a presidential election. And so, I find some peace and just some comfort in knowing that tends to occur. The other thing that I think is just important to remember and to think about, and I think this is a really powerful slide, because this is just showing us, on the one hand, on the left-hand side, we're looking at fund flows. And if you see there on year 4 where it says presidential election year, we can see that fund flows into cash versus the stock market is dramatically weighted towards cash in the year of a presidential election. And so on one hand, we're measuring the cost of concern. On the right-hand side, we're saying, okay, well, what if we're trying to, there's an opportunity cost for that, right? Because if we're looking at this and we're saying, let's only try to invest when there's Republican presidents elected versus Democratic presidents elected, versus just buying and holding throughout, regardless of presidency, the numbers, are dramatic. I mean, you can see that a buy and hold regardless of presidency is wins out dramatically over time. And so it's just interesting to see. I think this is just data that's helpful to look at when we're trying to determine, should we do something, should we not do something, what's going to happen in the year of a presidential election. And so I think that those statistics are important, because that's what we have to look at, and people can always say, well, this year it's different, this time it's different. I think you have to be careful with that type of language, because again, when we look at the way stock markets work, it's kind of cheesy, but like stocks don't see red or blue. They see green, right? They see earnings and profitability of a company, and that's really fundamentally kind of what drives the market over time. Certainly, certainly politics matter, and I think I've said it before. You've said it, Chris. We don't want to politicize our portfolio because we tend to lose if we try to do that. But just focusing on the fundamentals, the economy, and time in the market.
Right.
That's really what's important.
That's I think that's the important part here. When I think about, I've been at this 20 plus years now, talking with folks and making sure people understand what's going on within their portfolios. And when I think about this, that's been 9/11. That's been COVID. That's been multiple elections. And it seems like every time something happens, it is always this time it's different. Yeah. And the reality is, every time it is different. That there's no way that we can say that it's not. At the same time, while every time it's different, the market has that rhythm, and the market is continuing forward. And the good news is, the United States tends to be a strong, robust economy, not perfect by any regards, and we always have to watch out for plenty of things, but it continues to chug on and chug on and chug on. Yeah. Our job is to make sure that if there are any, significant changes that occur, that we're positioning folks right or setting right expectations. Right. I'm excited because we've got a lot of new tools that we're introducing and that we've really focused on, and more and more of our clients are going to get to see what that looks like in the coming months. So that's going to be terrific. All right. Well, this is that's our 3-2-1. Yeah. I mean, you your first walkthrough with the 3-2-1. You did a good job.
Well, thank you, sir.
I gave you a little bit more time than I gave Andrew last time. So, but you can tell Andrew that you beat him.
There you go. I sure will.
Now, for everybody watching today or watching the recording, if you've got questions about the topics that we talked about today, or you've got you want more specific guidance regarding your financial situation, we are always here to help. Always happy to be a sounding board for you or to assist in whatever way that we may be able to. You can call us or email us anytime with your questions about retirement income, investing, taxes, anything related to your money. That's what we do. All you have to do is contact us at hello@hobartwealth.com. We're here for you. If you want to submit a question to us for the Hey Hobart segment, you can send an email to heyhobart@hobartwealth.com as well. So as we wrap up, I am going to ask and encourage you, if you are enjoying what you're doing, you can always subscribe to our YouTube channel at The Wealthologist, and also tell people about us because, hey, we're trying to get some good information out there, and we appreciate you taking the time to join us. We hope that you found the information useful, and we hope to see you at our next Wealthologist Live that will be coming up in the next month. Have a great rest of your July. Enjoy the Olympics, and we'll see you soon.